Brent Layton. I'm the Chair of the Electricity Authority, and it's my great pleasure to welcome you along to what has turned into a regular annual event here in Wellington early in the year, our Stakeholders function. And it's very useful to have the opportunity from a regulator's point of view to interact with such key stakeholders in the industry. So I'm pleased that we have that opportunity. There's going to be two of us talk this morning. I'm going to start, and then Hansen's going to continue on. So first of all, I have colleagues on the Electricity Authority Board, of course. David Bull, who's a wine grower and engineer from the Wairarapa. Susan Patterson, who's down the front here, who's from Auckland and a well-known company director of long standing. Roger Sowry, who's there, works in the communications industry and is a former government minister, and Eleanor Trout, who's another engineer who is a former director also of Transparency as Susan, and as was myself. But Eleanor has been on the board with the rest of us from the beginning of the Electricity Authority. So there's always been five of us, and we've always been the same five of us. What's the objective of the authority? I've talked about this last time, but I think it's important because the authority continues to go back to what its objective is. Its objective is to promote competition, reliable supply and efficient operation in the electricity industry for the long-term benefit of consumers. And that's set out in Section 15 of the Electricity Industry Act. So our role is really to promote the long-term benefit of consumers. And for that reason, many of our stakeholders will not be particularly happy with all of the decisions that we make. That's almost inevitably the role of a regulator. But we have issued a 15-page document that elaborates on how we will interpret that statutory objective. And we've also more recently issued a strategic directions document explaining how we intend to pursue these objectives in practice. And our approach is to, first of all, try and reduce barriers to entry, barriers to expansion, and barriers to exit for suppliers in the industries. To facilitate, secondly, facilitate consumer participation in both the wholesale and the retail markets. Thirdly, to continue to refine market arrangements and alter transmission and distribution pricing guidelines to provide efficient price signals. To promote flexibility and resilience in the sector. To adopt fit-for-purpose market services, that's the system operator, the FTR manager, the market manager, the settlements, and so forth. And also to increase compliance with the market rules. I'll start today by talking about the management of the hydro conditions. That went well again in 2013, it went well in 2012, and it went well in 2011. So we've now got 3 years in a row where the management of hydro conditions were. And that's despite, in fact, there being some flip-flopping of the hydro state during the year. Those of you who've got long memories will recall we had lots of inflows at the very beginning of the year, led to very high lake levels. But then we had a period, and quite a lengthy period, when there were low inflows. And if one looks at that chart, the blue line shows you the aggregate lake levels. The sort of greyish line is the average over the 82 historical years for which we have that data. And you can see it makes a nice smooth curve from the beginning of the year, and bottoms out around October, then starts to rise again. And the orange/red lines at the bottom are the lines that indicate whether, if you pass them, whether there is at the top one a 1% probability that we'll run out of water if things don't change. At the next one it's a 2%, and the next one down it's 4%, down to that solid red line which says there's a 10% probability we'll have a supply issue if the circumstances don't change. So that's a critical sort of statistic and published very frequently that allows us to really monitor how the hydro conditions are being managed. So we see we've got a lot of inflows occurring beginning of the year. They used up a lot of that water, as we would hope, because it's relatively cheap to use excess capacity. But as the dry period started to extend into February and beginning of March, prices rose up. The authority held an inquiry into that and found that prices in that period actually responded as we would expect it to in a market. The prices did rise sharply, but that provided the signal to generators, which they responded to slow down their use of water and start using more of other energy sources that were available. And so our outcome from that analysis was, and as you'll see, we got not within cooey of the 1% risk level, so 1 in 100 chance of the water, and that happened through the market working. And we can recall back to the years up to 2010, before the Electricity Authority, we had periodic and regular crises about we're going to run out of water, hydro saving schemes and so forth. So it does look, at least at this stage, positive that the changes that were brought in as a result of the reforms following the ministerial review in 2009 have worked pretty well, because they were tested by one of the driest first 6 months of the year in 2012, and this year again in 2013. Again, things have acted as we would hope it would. But my main focus today is going to be on competition, which we monitor with a standard framework used by regulators, including our own Commerce Commission, of structure, conduct and performance. The structure, the arrangements between buyers and sellers, the concentration and so forth, which we measure by things like the concentration indexes and by the Herfindahl-Hirschman index and various other levels, tell you about the structure of the market. Do you have a single buyer, multiple buyers? Do you have single sellers, multiple sellers? Then what are the barriers to entry is another structural issue that we look at. The structure in a market tends to lead to the conduct in a market. That's pretty clear, and so we look at things like are there output withholding signs, and that was one of the things that we were clearly investigating in late February, early March, as behaviour was there's something going on there that was curious bids and offers, signs of showing withholding, or other things that suggested that the conduct wasn't competitive. And do we see competitive market activity going on, the sort of things you'd expect to find in a competitive market of this nature, where you'd expect new entrants to be one, you'd expect people starting to try and differentiate their products. In a market of the current maturity, you'd also expect to be seeing a proliferation of special discounts, special deals, and things like communities of elderly people deciding to have their own retailer and competing with the existing suppliers and so forth. So we look at that conduct of what's going on. But ultimately, consumers actually want performance. And that is the third stage of it, and if you actually think about this, this is sequential. You have to change the structure to change the conduct. That takes some time. And then after you change that conduct, it again takes some time before you get the performance. And that's when, and we have reached in the last year or so, the stage where we have to start looking at prices versus cost indicators. Are they moving as one would expect? And contrary to popular belief, a fall in demand does not mean that prices go down. The price in a market is determined by the interaction of both supply and demand. So you have to analyse what's happened to supply as well as to demand in order to be able to tell whether you have had the reactions that you would expect in a marketplace. So this parroting out that I have seen some people having, oh well, demand is down. It's actually not down. It's flat, but it's not down. But that demand is down, so prices have to be down. That it's not means it's not competitive is not a proper analysis using just basic economics, because you have to also look at what's happened to the cost of supply to be able to reach that conclusion. And the people who make those statements usually don't. So we have to look at prices versus costs. as well as the demand versus the current supply. And then we look at innovation indicators. Are we seeing dynamic effects in the market that we'd hope to see in it? And it is that performance that ultimately consumers are wanting. The dynamic innovations are usually about choice, consumer choice, and having options to tailor what they are buying to what they want. So one started out in the electricity sector with a structure which was basically a single buyer, single seller market, and we have over years transformed, and with some reverses on the way, but at the moment we're working on the competitive market and looking at the performance that we're hoping to get. So what does our observations say around those areas? Well, New Zealand has 14 electricity retailers. Some of them are relatively small. In fact, quite a number of them are. There's 5 big ones, one sort of modest-sized one nearly modest size and growing very rapidly, Pulse, and then a range of other smaller ones. And they have 22 brands in a market, and getting multiplicity of brands for different retailers is actually a sign of a market's starting to show competition. It's an obvious competitive response. When people start shopping around, you want multiple brands because the chances are they'll end up back with you, even if they're with a different offering. And we've had some emergence too of some disruptive retailers. So will one of them be? I think Grey Power Energy, which we have 2 representatives of here today, are starting to be a bit of a disruptive force in the marketplace. They have targeted a particular segment, although they tell me they're open to offers by the less geriatric than myself. So they are starting to show that. But we are finding there is a range of players out there. We know actually we've got dialogue currently with 9 other parties who are interested in becoming retailers in New Zealand, who are currently talking with us. We think, and we of course only regulators have our views on this may be totally inaccurate, but we think 2 of them are serious enough to start this year. Some others might be further off. That's not counting in that 9 one big switch, which is an Australian group switching business that specialises in switching groups of people to new retailers and has a business in that, who've also announced that they want to enter the New Zealand market. And it doesn't include 2 parties whom we know have carefully looked at setting up a retailer and have decided that from their perspective there's not enough profit margin to be made in doing it, which in itself is an interesting outcome for a regulator to observe. So we have 9 parties currently looking. We have 2 who we think may progress this year. There could be more, there could be less. We have another party looking at a different arrangement than being a retailer themselves, being a specialist in switching. And we have 2 who have looked and decided not to progress. And the small retailers have been increasing sharply. Now the scales of these are totally different from the left and the right. But it's at the margins in economics that, of course, the dynamics really occurs. It's at that marginal producer, the marginal consumer, that drives what happens overall. And the blue line there is the small retailers, and you can see they really lifted off after the electricity authorities got into action in the very late end of the Commerce Commission. Once the signals came out of the ministerial review in 2009, I'd like to claim that they're probably being overly generous to the ministerial review. But we have a bit of a blip there, which is Energy Direct, which left Meridian and then got sold to another entity, Trustpower. So it went out into being a small retailer and came back into being part of one of the major ones. Now the scales, I would emphasise, are totally out of whack with one another, but it does show there has been in the last few years quite significant rise. And we've also seen a difference in the futures market between the long dated and the short dated. The brown one here is the average prices for short duration futures contracts since July 2012. And the red line is the long dated ones, which you can see to move around nowhere near as much. and you can see from the middle of 2012, went down to the end of 2012, early 2013, when we held our last stakeholders briefing in the city. They had reached that level. They have flicked around a little bit from that, but they have held that longer term trend through it. So that in itself is a rather interesting phenomenon, but we also have had posted residential prices have increased 3%. If you look at the latest, which is the December 2013 quarterly, the December 2013 quarterly survey of domestic energy prices, MB's data. The energy component contributed 2.2. This is a measure of retail prices, a measure. Distribution and transmission contributed 0.8 of that. So we've had last year an increase in retail prices. Now, one of the things about that particular series of statistics is that it doesn't include many of the special discounts that are offered to people. That's because the data is about what a typical 8,000 kilowatt per hour a year consumer might actually pay if you believe what the company asks for. And tells the collector of the statistics. So it's not actually a very good reflection of what people actually pay, because it fails to get the special deals, fails to get special discounts, fails to even get electronic payment discounts. It gets prompt payment discounts, but not discounts that occur for electronic payments. These are all health warnings that are there in the statistics, but you shouldn't let, I think as the New Zealand policy mantra, you shouldn't let facts get in the way of a great story about what's going on. So it hasn't been capturing those. And MB is currently going around trying to collect better statistics that might tell what people are actually paying. And some of you are providing data. I know it may seem a bit of a pain to you, but I think it is important we do actually know what is happening to what people actually pay. I have Marie as my electricity supplier. I'm such an appalling potential customer that nobody has ever offered to take me off Meridian. And I've never been approached, which I think, given the surveys we conduct, I must be one of the only people in New Zealand who's never been approached. I do pay my bill on time, but I have noticed by looking carefully at their bill that my electricity expenditure is actually going down, which I found rather interesting. But I've been putting in LED lights, so I may not be actually saving money, but that's a different issue. Anyway, 2013 attracted a lot of discounting, special discounting going on, and as we would expect at this stage of the development of competition in the marketplace. It's what you do when you get to this point. You don't start offering cheapo prices to everybody. We wait for competition to really heat up for that to happen. You look to retain the customers you want to retain, and there are elements in our market which facilitate that, and we're looking at whether we should change those elements. So we've seen ad hoc discounts for residential customers ranging between $80 and $300. Now, an upfront discount of $150 is a 6.9% price reduction for an average consumer. And that amounts to 1.9 cents a kilowatt off the average of around 28 cents a kilowatt hour. And they have been there for people who want to shop around. And we know from the anecdotal evidence that we get that commercial and industrial sectors have been offered somewhat similar discounts, some of them up to 20%, but looking more like 2.5% out of 40.5%. Now their prices are lower because they don't pay a lot of the other costs that are related to it. They don't pay GST. Not a matter that retailers put in their pocket, but it's something that they have to charge household consumers. And we have seen that so we have seen the reduction in the futures prices, which I showed you before, starting to flow through to some consumers and those who shop around. And that implies at least that there has been some effect on the residential consumers who are in that category. But that's not everybody, of course. As I said, you really do need to look at cost if you want to make conclusions about whether markets are competition relative to price. And so what we did was we commissioned NZIER, a well-known and reputable organisation. They do use models, but so does all of economics, apart from one economic commentator who thinks that models can't be used in economics. And they do think that historical cost is a valid method of asking a question about whether people have paid off for past costs of investment, the opportunity cost of that occurs, whether it's commercial or non-commercial. It's the muddled thinking of the 1960s and 70s that led New Zealand to so much economic trouble, that says there is no opportunity cost of capital if the government has spent it through taxes. That is not correct, and it's not a good basis for policy, no matter how many journalists would say so, or political commentators. Anyway, what we did was we got them to look at this. Fortunately, the futures helped with this, because it tells you what the opportunity cost of the wholesale market is to a generator, because they could always sell it in the futures, or they can always buy it in the futures. So it has set a market price. So they said that by the late 2010, the futures were probably sufficiently robust for them to conduct an analysis, and they therefore analysed what were the cost drivers for a hypothetical standalone retailer. But that's every retailer, because whether they stand alone or not, they still face that same opportunity cost. So it is actually a reflection of the costs on them. And they broke it down into the blue colour, which is the cost of energy, the yellow, which is overheads, the red, which is distribution costs, the grey, which is GST, and not in the intention of being non-transparent, we added the EA levy in there because it would have been too thin a line to actually see in these things. And then we had and transmission, which is the light blue. And this won't come as a huge surprise to most of you, but one can see that the blue, the dark blue, which is the energy cost component, has recently in fact fallen away as a cost driver, and from the end of 2012, just before we held our stakeholders briefing last year, and has gone all the way up to 2013 and is now making a negative contribution to the overall. But as you'll also all know here, transmission, light blue, comes through in June quarters and was a modest contributor in 2011, was a very sizable contributor in 2012 to the cost drivers in the industry, and again a sizable contributor in June 2013. That's because we have been investing a whole lot of money, which was approved by a regulator, not the Electricity Authority, but the Electricity Commission and subsequently the Commerce Commission, as being in the net public benefit, and it's now being paid for. The other is the distribution costs, red. Again, it's June quarters. They reset their prices at the end of March because they have the transmission costs they want to pass through. And again, you get a significant contribution in each of those June quarters to the cost driver. And of course, we also had GST, which came in at the end of 2010, going from 12.5% to 15%. And had other effects throughout the period. So that's what's been happening to the cost drivers. So they have flattened, and eventually, recently, in there is a little line there for December, but slightly positive in overheads, but negative, neutral on the others. So that's work that we have been doing. Looking at the actual costs of industries, not the historic costs. That's relevant to an argument about historic costs. People read press releases, they would know that that's what we said. But that seems to also be a bit of a failing in this country. Anyway, costs that we've charted, and what we do know is that our cost estimates are understated. They're understated because of the impact of the impact of peakiness in the price of energy. The data that's been used, because the only data that's been available until recently is of course the base level futures contract prices, but they are for a constant level. But to serve somebody with peakiness is actually more expensive, and is becoming our analysis suggests possibly more expensive over time as you need to deal with getting into higher cost options for producing when things are peaky. The red line is the MB Residential Price Index. I've already said that doesn't include the discounts, so it's overstated as to what the actual prices are for households. But what this chart shows is that the costs facing generators until very recently have continued to rise and have been rising faster than the prices that residential consumers have been paying, even when you take the biased set of statistics of MB and make an assumption which probably understates the cost increases. That is consistent in our view, given that demand has been pretty flat the last few years, with being reasonably optimistic that competition is at least starting to force producers to wear some of the cost increases rather than pass them all on. There have actually been two extended periods of residential prices rising faster than the commercial and industrial, small industrial prices, not the heavy industrial prices. And what this chart shows is the blue line is the residential prices in 2013 dollars, so we're dealing in real terms. What the brown line is the commercial and light industrial prices, and the red line is the heavy industrial prices, so it's those of the major, often direct connect, but not all. Fonterra is a case where it's often not direct connect, but it's the major industrial users. And you can see that there have been two periods of rising prices for residentials. One going from about 1985 right up to 1998, and the other from 2001 up until 2010. Note, this chart ends in 2010 because MB have discovered that there are some issues with this data, and it's actually trying to correct the data in the way it's been collecting it recently. So we don't have 2011, 12, 13 data that we could add, which would be useful to have. But you see those two periods. And we've got the first period, 95 to 98, when residential prices rose and commercial and industrial prices actually fell. And what this was a period of rebalancing. In the beginning of that period, in 1985, electricity prices were largely politically determined. And they were determined by bodies that had electors whom they liked to pander to. And so they tended to charge the public who had much more voting power than the businesses a lot, and charge the businesses a relatively small amount. Underlines some of the stuff that we put out in our historical cost paper. And we got, of course, as the market changed, a rebalancing of that particular effect. We then had a period, and it's worth pointing this out, when in real terms, prices of all three, or well, two of the three, commercial and industrial and residential, went down in real terms. The market was introduced to full competition for retail in 1999, and prices for the next 3 years actually fell in real terms. So it's just not true that prices have risen in real terms ever since we had a market introduced into the retail market. Yes. But again, some people are very keen to make sure that facts don't get in the way of a very good story. So we did have a period. Notice actually the industrial went up slightly during that period, but not majorly. Then the third period we have is we've had all three of them rose from 2001 up to 2009, and more recently two of them have started to go down. One of them ending in 2010 hasn't, but the signs are that if you had the data and took into account properly the discounts, that too has probably been going off too and more recently. But let's focus on that. That's a different beast than the 1985 to 1998 period. This is a period when, in fact, we had gas redetermination of the Maui platform, we had gas prices rise by 95%, we had diesel prices rise by 55%. We were running out of the hydro capacity that we actually had that was spare, and we started to need to build new capacity, some of which was more expensive, and so forth. So there were a number of factors driving it, but still leaves the question of why did the residential go up faster than the commercial and light industrials, and go up faster than the heavy industrials, even in real terms. And one of the potential hypotheses that we have worked on about this is that one of the characteristics of the residential compared with the industrial users is that they have much peakier demand, and they have much bigger seasonal variation in demand. And it's at those peaks that you have to use the higher cost generation capacity. So that as you ran out of the cheap hydro and started to have to put in those new plants, that was reflected in the cost, but particularly in the costs of residential. And at that time, of course, as you've got commercial, you've got competition in the marketplace, that couldn't get averaged across. A retailer who decided to average that across every would have lost the commercial and industrial base. So that's one possibility, which we think is a variant on that. Another possibility that we have looked at recently is the impact of ACOT payments, avoided cost of transmission payments, which came about as a result of a regulatory change. Small distributed generators have been paid that, and as our recent working paper for the transmission pricing methodology suggested, that figure has risen from zero being paid to $50 million, and all of that subsidy for small generators is coming out of residential consumers because it's being paid by the distribution companies, who tend to pass it straight through to those customers. So that's maybe another contributor. But we think the predominant factor, although is the peakiness. And here's, of course, you don't get nodes in the electricity system absolutely purely residential and absolutely purely light industrial. But Paia 2 is about as close as you can get to it. It has nothing to do with the fact that Professor Evans lives off that node. It just happens to be a node that doesn't have much industrial activity associated with it. It gives a fairly good reflection. And I could go into all the details of what this rather complicated diagram shows, but if you just look at really the big bits, it shows you the fluctuations of residential demand over the course of a day. It's averaged right across the whole year of 2013, giving the maximums, minimums, the quartiles, and the averages over that period. So you can see very low demand from residential houses at midnight. About 6 o'clock, people start to wake up. Demand goes up, they then all chug off to work, demand goes down slightly but it doesn't return to that initial level. Then they all come home from tea and the demand goes up, they watch telly and stays up for a while, then they all go to bed getting on towards 9:30, 10, 11 o'clock at night, and demand goes back down to the lower level. And you can see that between the bottom and the top there's a range of 400%. So it is very peaky. Compare that with Dewey Point, which is a classic heavy industrial load. It doesn't vary much at all. Very static. And so it's essentially a baseload electricity that's coming through and being, in that case, so what we did was, at the Electricity Authority, we did some modelling. It isn't possible to find numbers that don't exist without modelling. You have to do some modelling in economics, just like you have to do so in oil exploration and almost every science. You have to do some modelling. So we did some modelling and we calculated what those ratios were. Up until about 2000 in this chart, we had the hydro, so dealing with the peak was not a problem. Hydro is very good in that. You can run water through without at the peaks, back off a bit the rest of the time, allow the water to just store up and run off through the peaks, so it's very flexible in that regard. But when you have to start adding gas and others, so this shows that it was a nearly 20% premium for the red line, which is residential, where it was about 6% lower for the cost of commercial and light industrial, and about 15%, tailing off to a bit over 10% for the heavy industrial, to deal with an incremental unit of extra demand from those different sources. So there is a difference in the cost, and this is what we're signalling is going on in terms of that peakiness. So let's turn to the wholesale market. There are 75 separate generating entities in New Zealand. That's not plants, that's generating entities, that's different businesses. Yes, there are a number that are quite large, but there are 13 of those generators are directly connected to the grid. The balance are of course connected to distribution networks, and through those are connected to the grid. So all of these contribute in one sense to the grid. We haven't added the generators in the other three grids than the main grid run by Transpower that we actually have in New Zealand. I explained to you last time we actually have 4 grids in New Zealand, but the others are pretty tiny. Chatham Islands, Southwestern, Stewart Island, and then you've got the main grid. So we haven't added those other generators as maintenance. And then the concentration ratio, the Hirschfeld, the HHI, the Herfindahl-Hirschman index, which is a measure of market concentration. How you get this number is you just take the market shares of each participant in the market, you multiply it by itself, and then you add up all of the numbers that you get. Now, if you have one entity that has 100%, 100 multiplied by 100 is 10,000. So the top value of this index is 10,000. If everybody had a tiny little amount so it was indistinguishable from 0, you would multiply 0 by 0, you get 0, add up all the zeros, and so the bottom of the index is 0. Somewhere around 3,500, 3,000 is thought to be a reasonably competitive market. And you can see even back in 2004 we were at that level, but the trend has been down, reducing levels of market concentration by this particular measure. And if you take other measures of concentration that are used, the concentration ratios and so forth for 1, 2, 3, 4 firms, you find the same evidence comes through. But you don't want to be bored with all of that. So this is suggesting that the wholesale market at least has enough generators to be reasonably and to spread of them. And some recent work that we did in the authority was looking then, it said, what's the opportunity for generators to influence the spot market price? So when can a generator raise its offer and as a result raise its the price in the marketplace? So we developed a statistic to do that, and of course we have a system that allows us to rerun all of the electricity market every half hour for every day. So we have all that data, so this is easily modelled to work this out, and we did that. And we found that it's at most, and we've got different companies here, we've got Contact Energy, and we've got Contact Energy in the South Island, Contact Energy in the North Island, Genesis in both islands, Meridian in the South Island, Muddy River in the North Island, Trustpower in both islands. So we've looked at the major generators and said, what's their ability? Ability doesn't mean to say they did it, it's their ability to, in fact, raise their offer and raise price as a result of it. And you can see that, in fact, the SOEs particularly had well below 20% possibility of doing that. Trustpower and Contact seem to be the ones that have a little bit more power to do that over time. And they're different years, 2010 right up to 2013. But I said this is the ability to do it. But to do it profitably, the generator has to be in a position where it'll make money out of doing it. And you can't make money if you've got more sales than you've got purchases. So Trustpower, for example, always has a net retailing position. That is, its sales are greater than its generating capacity. So it's always short in the market of generation. So it raising prices will mean it pays more for what it buys than it'll earn off what it sells. So it has no incentive to do that. You have to look at the hedge positions and the contractual positions of other parties. So we went and did that. And what do we find? This is done by years rather than by particular companies. Contact in the North Island and the South Island are light blue and dark blue. Genesis, North Island, because it's largely focused there. Meridian, South Island and Mighty River. There's no point doing Trustpower because we know what the answer to that is. It's a net retailer. And some of the smaller ones, there's no point really dealing with those either. And the really interesting thing here is that while Meridian had a number of occasions in 2009, 2010, all of that has disappeared. So now there's very little, very infrequent occasions when it would be both possible and profitable for generators to raise their offers in the marketplace. And what happened in 2011? Well, the Ministerial Review in 2009 recommended asset swaps and virtual asset swaps. And the effects of those asset swaps and virtual asset swaps actually did away with what residual potential, and it wasn't great originally except for Meridian, and I'm not saying they actually exercised it, that's another issue, they still have to decide to do it, did away with that possibility out there. And what we've been left with is local events. So Tekapo goes out and you have a local island thing, you have occasionally issues around the very top of the South Island. Most other areas can't happen because there's enough transmission capacity that it's not possible anymore. But there are some residual places where there is potential on odd occasions. And however, as the gentailers know, WAG has come up with some proposals of how to deal even with that issue. And the authority is at the moment drafting the code that will deal with that residual issue too. So, Bruce, you can take credit that MB came up with a solution. It took a bit of convincing the odd politician that they should do something so dramatic, but it certainly has had a quite noticeable and direct effect on that pivotal position and the incentives around dealing with it. So let's summarise. The market successfully managed the volatile hydro conditions in 2013. In our view, Transpower did really well, commissioning new assets in that environment. If you recall, some really big investments in the HVDC, everything that you could ask for was thrown at managing that. Not only Transpower, but the rest of the market managed to cooperate, and they had the incentives to cooperate, which I think were right, and the structure that led to that. So, at least tentatively, currently policy settings for security of supply appear to be working very well. Another changes that came about in 2010 and were introduced gradually after that. The evidence also points to pretty strong competition in both the retail and wholesale segments of the electricity market. In particular, both residential and commercial and industrial consumers received significant price discounts in 2013 if they shopped around. And costs for a hypothetical standalone, in fact, any retailer, if you take it, it's the opportunity cost is reflected by those futures, rose faster, and probably that's an understatement, over the last 3 years than residential prices. Sharp increases in the cost of supply, supplying peaking demand since 2000 may largely explain why prices rose faster for residential consumers than for other groups. And the 2009 asset swaps have largely eliminated the ability and profitability of generators to raise spot prices over large areas of the country. At that point, I'll hand over to Carl, who will tell you about what we're doing to increase competition further.
Thank you very much, Brent. Look, I'm aware of the time, so I'll try and keep this relatively brief. We will be putting up our slides on the website, and we are quite careful to write notes pages so people can read further on that. So I'll just do a very quick kind of overview, but I did want to welcome you to our 8th stakeholder function. So every year we run 2 of these, one in Wellington and one in Auckland, and the purpose of them is really to set out our work program, but also things that have been happening in the market. And so we really appreciate the continued attendance. There's a very, very healthy attendance, and we appreciate your attention. So Brent has really given you the real oil on competition in the market and how it's developing, and some of the evidence that our market performance team and their consultants will be able to compile But we've got a lot more we want to do in that space. Brent had put up the structure, conduct, performance framework, and there's a bunch of indicators there that we still need to work on to be able to provide more information about how things are actually working in the market. And if there's any researchers in the audience, I heartily encourage you to barrel on ahead of us and see if you can do some of that work too, because we do have limited resources and limited time, and a lot of what this is about is digging through the data and compiling new data and finding new ways of actually extracting out from the data what is actually happening in the market. So it's not a job just for the authority. Heartily encourage others to do it as well. But fundamentally, the authority has a mission really of promoting competition to deliver long-term benefits to consumers. And in our view, it's not really a case of whether there's enough competition. What our Act says is that we are to promote competition whenever there are long-term benefits for consumers. So we're not interested in the story that there's a strong competition, let's stop now. What we have in place are a set of, a work program, a set of possible initiatives that we want to work through, and if they pass a cost-benefit test, that they're going to bring efficiency benefits to the economy, then we will deliver them and we will take them. And to deliver even greater gains to consumers. So that's what's driving us in terms of our work program overall, and we have a number of pro-competition initiatives that stretch right across a range of markets. But this morning I just want to focus on the retail market initiatives. And one of the features that you would want from a competitive market, as Brent I think was outlining, was that you want prices to be reflective of efficient costs. And at a minimum, you want prices or changes in prices to reflect changes in costs. It may not be efficient costs, it may be actual costs, but at a minimum you want prices to reflect what's going on in the cost and demand side of the market. But what this chart shows is there's actually widespread perception out there that the retail market isn't workably competitive. If you look at the bars to the right on that chart, we do surveys of consumers. We did one in 2011 and another one in 2013, exactly the same questions. And we also ask stakeholders, that's lines companies, investment analysts, generators, retailers, consumers, representative of consumers and so on. So the stakeholders are the insiders, people that know much more about electricity than the consumer group, which is a mass market survey that UMR does for us. And it's quite striking that, in fact, in both cases, recorded in our survey in February 2013, that only around 22% thought that they agreed with the statement that the current level of competition between electricity retailers ensures that prices only rise in line with the cost to electricity companies. And yet we have the research results that Brent presented earlier showing that, in fact, prices for residential consumers have risen much more slowly in the last 3 years than costs. So it's quite the reverse from the evidence than what seems to be the perception out there. And perhaps that's partly a legacy of ongoing price rises as you've had that rebalancing in the first period, 1985 to 98, and then of course the cost increases that have been coming through into the sector in 2001 to 2008. So the question for us is, are the poor perceptions reflecting a lack of competition? And from our perspective, residential consumers, there could be quite a different kind of experience going on for residential consumers that are actively shopping around. They do seem to be accessing quite significant discounts, but other consumers that are much more passive and not engaged in the market, maybe there isn't the kind of level of rivalry between the retailers to deliver enough competition to them, and maybe the perception results on the previous slide reflect that. It could also be that it's kind of pretty risky for small and new retailers to enter the market and expand and take on the incumbents aggressively. So Brent had a chart there that showed there were quite a few independent small retailers, and we're talking to another 9, but are they working to really take on the incumbents aggressively in terms of pricing? And so that's an open question. But I guess the second part to it is, well, maybe, there is quite strong competition, but this is largely just a perception issue. And that's quite possible because of the legacy effects, but also pricing structures in electricity are quite complex. And, it can be difficult for consumers when they're shopping around and looking at different websites and looking to find the best deal, to actually find it really difficult and get quite confused and not be active. So we do have some work to do in that space, we think. And from our own perspective, the market monitoring space, we feel that there's incomplete data in the retail space. It is hard for us to compile an accurate index of retail prices in the manner that we need to do our market monitoring job. So there's a bunch of reasons why we're not able to put out really detailed reports at this stage that would actually influence the perception issue. So it could be a competition issue, it could be largely a perception issue. We really are at the point where we think, well, it could be elements of both. And I'm just aware of the time frames now, so I'm just going to very quickly go over a couple of slides, leave it for you to review. But we released last week a major consultation paper. It's an issues paper on looking at access to retail data. It's retail pricing data, tariff plans, which is the schedule of prices, consumption profile information, whether consumers have good access to the kind of information they need to find the best pricing in the market for them. And so that paper is really setting out the set of issues that we think are inhibiting us having a really good retail market monitoring job. We think it's inhibiting quicker and easier access for consumers, or quick and easy access for consumers to retail prices and their connection point data. And third parties, we know there are some real serious barriers out there in regard to their ability to access data and actually facilitate consumers making the kind of choices and to get the best plans for themselves. So I'm going to skip through that, but we put out in that paper quite a range of issues that we want feedback on, and we'll then decide what's the way forward. We've tentatively suggested that maybe there's a lot more we can do to provide consumers and third parties access to granular and comprehensive information in a manner that allows them to really quickly find the best deal in the market and to trust that result, to trust the results that come through so they will act on it. So we think this kind of work that we're looking at now, we don't really need to discriminate between whether it's a competition problem or a perception problem, because we view that addressing some of these issues will address the issue whether it is competition or perception. So we'll see how that plays out. We'll look forward to submissions. I think the closing date is the 11th of March, and I highly encourage anybody here that's got the time to have a look at that paper. It's very simply worded and very accessible. What I wanted to do was just very briefly outline for you the set of initiatives that we have underway. The kind of two ways we look at it is both sides of the market. So for the retail competition, we'll look at the kind of things that might inhibit new entry and expansion of new entrants into the market. And I like to set up a structure here where I have the transport as the underlying physical structure, that's transmission and distribution, and then on top of that we have a set of markets, and each one builds on the other. So at the bottom you have the ancillary services market, which is frequency keeping and instantaneous reserves and so on, and then on top of that is the spot market that feeds through to the hedge market, and then finally the retail market. And I'm not going to work through each of these. I just wanted to put them up and show you that we have around about 9 initiatives that spread across those markets that all go to the issue of reducing barriers for new entrant retailers, or improving the risk profile within the spot market, which will actually help new entrant retailers, or altering the way the number of instruments and products available in the hedge market so that retailers can manage the risks from the spot market better. And then lastly at the top, a set of work that we're doing directly related to retailers in the retail market. And the blue one at the top, and improved third-party access, is just what we've been talking about in the previous slides. Oh, okay. Oh, crikey. Okay, let's go this way. Okay. My last slide. One moment. Thank you. Looks pretty complicated, doesn't it? Custom show from current slide, I think you'd want to do. Well, we can see that. That's good enough. So my last slide is really just, the previous slide is really a range of initiatives that are about the supply side, that are around about how we can improve things for get a more level playing field and reduce barriers for people that do want to enter the retail market as suppliers. And this slide's really about the demand side of it. It's really about the consumers and things that we can do for consumers to improve their participation in the retail market. And again, the blue item at the top is really comes from that consultation paper that I was talking about. But we do have a number of initiatives there around Retail Advisory Group looking at the transparency of charges and the transparency of the bills that they send out to their consumers. We have to make decisions around the What's My Number campaign and whether to continue with that. And many of you are very familiar with the low user fixed charge regulations and the review that's scheduled to occur on that. And lastly, the barriers to group switching. Brent talked about one big switch, but we have seen other initiatives in the Nelson area and so on. So we've got quite a comprehensive work program underway that is actually looking at how to better facilitate retail competition in the market. And not all of these will necessarily be adopted. They're in their research phase and their development phase, and we will do cost-benefit analyses to see whether, in fact, they're going to deliver long-term benefits to consumers. So what last thing I wanted to say is that we are releasing late in February our annual publication, The Year in Review, which is put together by Bruce Smith and Doug Watt from our market performance team. It's an annual publication. It will go through a lot of the material that Brent has presented this morning, and many, many other facts that are in there. There's a lot of modelling and good work that the team have been doing. So, and then in addition to that, we put on our website all of our data, all of our models and tools so that you can fiddle with them and come to your own conclusions.